Good morning. I'm Matt Morgan with the Advanced Ag Network, and here's the corn report for Friday, January 7th. Concerns about weaker than expected export demand weighed on U.S. corn futures Thursday as the market pulled back from a strong rally. March corn contracts slid 17 cents and settled at $6.02 per bushel. The contract is 22 cents below where it started the week. The national cash corn price decreased 18 cents to $5.90 per bushel and sits 24 cents below its 10-day high. Cash prices in St. Louis lost 22 cents at $5.96 per bushel, while in South Iowa, prices gave back 17 cents, settling at $5.78. The national corn basis widened by a penny to 12 under the March futures. We had a chance yesterday to catch up with Bruce Blythe, our business editor at the CME Group, to get his opinion on the corn market.
This is Bruce Blythe with the Advanced Ag Network at CME Group in Chicago. It's the afternoon of Thursday, January 6th. Grain markets fell across the board today, with March corn futures dropping over 17 cents to finish at $6.02 a bushel. That's down about 5% from a 29-month high we hit to start the year on Monday at $6.34. These declines partially reflect some rainfall expected in parts of Argentina that's bringing relief to dry conditions they've suffered from there. Argentina is a major corn exporter. There's also growing talk that these high corn prices are curbing demand, especially from the export side, and data we saw from the USDA today seem to reinforce that. Chad Henderson, who's with Prime Agricultural Consultants in Brookfield, Wisconsin, says he doesn't think we can sustain $6 corn just because of it's going to crimp demand, and he thinks that most of the bullish news has been priced into the market at these levels, and there's just too much bullish sentiment, too many people leaning to the long side of the market. However, we do have big reports coming in from the USDA on January 12th. They'll be releasing their final production estimates for the 2010 corn and soybean crops. Traders will be watching that very closely, and it'll probably key the next direction here. Also, the corn ending stocks will be checked closely. USDA pegged that at a 15-year low for the current marketing year. Any downward revision there is sure to provide support, maybe send us back further above $6. And we haven't traded below $6 here in the March contract since a few days before Christmas. Now, other markets, hogs have been fairly strong this week. The February lean hog futures hit its highest level since late September today at a little over 80 cents a pound, and it ended at 79.725 cents, up about 3% over the past 2 days. Pork demand appears to be holding up pretty well, especially relative to beef. It's lower priced, of course, and there's very little sign of expansion in the U.S. hog herd. Cattle started the year with a record high in the February contract at over $1.08 a pound, but it has faded here in the past few days. There's talk that the meat packers are going to be cutting back slaughter a bit because they're losing money paying for cattle at these levels, and they have to do something to cut back and short the margins. Once again, I'm Bruce Blythe with Advanced Ag Network at CME Group in Chicago.
This has been your corn report for Friday, January 7th. Have a great weekend.